Explaining the implications of the efficient market hypothesis on investment decisions by Anton and Keyaan. The introduction. On this presentation, I have put some of my own best advice for a young adult with inheritance of around £100,000 and my best possible choices for the person, with a conclusion at the end of what I think would be the best investment opportunity for him. The presentation is on a customer with no debt history and just wants a steady return of investment on his funds. Today's highlight, we have the efficient market hypothesis, S&P 500, bonds, AJ Bell stocks and shares, cryptocurrency and tax. The client lifestyle. The client lifestyle is actually based on a 21-year-old student who invested £100,000. And he's struggling with the most efficient and most reliable way of investing. It's normally looking for a long-term investment, so we've put together a portfolio for him, which I think would be the best way to invest his money. He has no debt history and just wants a medium risk investment, such as the categories we've listed in the next slides. So what the efficient market hypothesis actually is, we have three different stages of efficiency: weak form, semi-strong form, and strong form efficiency. We start off with the weak form efficiency. It's the market price is reflected on all past trading information with historical prices and volumes. That is weak form efficiency. Semi-strong efficiency is the price incorporation on all publicly available information. And we have strong form efficiency as well, which is the prices reflected on all the information which are available to the public and private, with even considering not being able to generate annual returns. And then we have the S&P 500, which was my first initial portfolio for the student. Here we have the current chart of the S&P 500 and the current price of it as well. When looking at the S&P 500, we would see that current trading price is around $526, which is about £500. And this is as of April the 10th, 2025. I would say since Donald Trump came in, the S&P 500 has actually had we had a big spike of around 8% at the start of his back to the throne, I should say. And now we've actually had a surge of around 6% today alone, and in the last 7 days, around 11% on S&P 500, which is a huge loss. But overall, it's the most reliable and most reliable investment in my opinion. My proposal for S&P 500. So we've got global equities, which is around 50%, which is about £50,000 of his funds. That would be good. It's an S&P 500. It's quite a common and most reliable way of investing, as you will see an annual return normally around 8% a year, with an investment of around 5 years, which is what a client wants to do. UK equities, which is normally the FTSE 100 to 250, which is divided incomes, which is two different currencies actually. We'll do the bonds as well. We have UK bonds as well. That's just more of a safe opportunity for steady and slow income, as normally bonds do actually fluctuate with the actual prices. And also say real estate, obviously investing in houses and properties, things like that. University student houses and other ways to Airbnb as well. And cash, always having £10,000 cash as a safe on rainy days. And it's short-term liquidity, it's just going to be in your bank, maybe a little bit of interest in there. And we have now bonds. Bonds are very safe. It's quite a reliable way to actually invest. Most people use bonds because it's a slow investment. It's not a strictly a percentage increase, because bonds do change based on the inflation rates. So sometimes you may have a lower income than 1 month than you would in the second month. Sorry. Bonds are normally used by large companies and also the government, as it's quite a steady and slow income. I would say it's basically considered low risk bonds, as no one's really using bonds as a fast income. It's more of a slow, reliable way to make money. The risk and returns of bonds. So some risk of bonds are just generally the inflation prices might not be high, they might be quite low. You might not see a quick return of investment, and profits do seem to change all the time as well. So it's not strict income, strict percentages, and obviously profits may not be as large as you expect sometimes. Bonds and also returns of bonds. Sorry, that was risks of bonds. Sorry, returns of bonds. It's a stable income way of investing. Obviously, stocks and shares are quite a high risk, more volatile market than bonds. But obviously, bonds do not fluctuate prices quite often. It's quite a steady price range. AJ Bell, stocks and shares ISA. It's a stocks and shares ISA is quite efficient way to invest. It's completely tax free, and obviously you can take your money out and invest more money if you want to, whenever you want, and it's your account. With AJ Bell, investments are up to £20,000 per calendar year, so that'd be a good idea for the student to actually invest £20,000 on his first year of being with AJ Bell. It's free to withdraw your money, and whenever you need to, you have full access to your account. AJ Bell can have a risk in the market volatility, as the markets do actually fluctuate quite a lot when it comes to stocks and shares, and government empowerment also can change the prices in stocks and shares. Global economic risk. So yeah, for example, Donald Trump, when he came in, the stocks and shares, the market went up, shot them up massively. Liquidity. The average trading volume is around 2.3 billion shares per year, as of 2024 last year. The growth annual return has been last 10% in the last 10 years. So obviously it's quite a reliable way to invest your money. And the risk is actually, in the year 2020, the stock market dropped by 12%, which is not regular, but it does happen now and again. The potential risks in stocks and shares and using AJ Bell. Market risk, we know the economy does actually make the market have a different price. Obviously, you can change the price based on who's in power, etc. Any global events, wars, things like that. Obviously, downturns as well, so company empowerment. Volatility risk, stocks and share prices are very volatile and result in all funds being lost at a short period of time, which can happen. News releases, so any news articles, etc. Earnings reports and investment settlements also change the prices of risks, and they are the potential risks of stocks and shares. Reason why I would say go for AJ Bell is they have access to 4,000 different funds. They are a UK and international store. They're based around the UK normally, which is good for our client as there's little to no knowledge about the actual company itself. AJ Bell is generally best off. It's hands-free. It's quite user-friendly. Anyone can use it. You can have it on your phone, your laptop, your TV, anything you want really. And they look for long-term capital growth and passive income.
Main shot. Cheers. You may have heard of a form of cryptocurrency like Bitcoin and XRP. Cryptocurrencies can generally be considered safe as it operates on a transparent and safe, secure distributed ledger that records all transformations, which is called the blockchain. This type of currency is not issued by governments, so it's not subject to political influence. With regard to the liquidity, their assets are highly liquid, so conversion is quick to cash, and also other cryptocurrencies trading is open 24/7. For the growth, crypto's global market value stood at 3.28 trillion in January 2025, up to 98.8% from the 1.65 trillion cumulative market value. Cryptocurrencies are highly volatile, exposing investors to significant risk and regulatory uncertainty. For the rewards, early investors to cryptocurrencies can see massive gains if the coin is successful. As cryptocurrencies are decentralized, they're granted more financial freedom. It's very inclusive when it comes to who can access it. All you need is an internet connection. You could be on the moon. As long as you've got internet, you can buy some Bitcoin. You can make an insane amount of money on cryptocurrencies, on these things called crypto pumps. The legality of this is a bit uncertain, but there's no laws against them yet. You have to be in early. For the risks, Wallets and exchanges are constantly vulnerable to hacks. If you are hacked, your money can be transferred to the other wallets and be unrecoverable. There is nothing you can do about this. And on plenty of exchanges, customer service is not the best. Governments around the world have different views on crypto, so future regulations could impact their value or legality. It is difficult to predict short-term outcomes due to the high volatility of cryptocurrencies, and as crypto is relatively unregulated, the market is prone to schemes which can artificially inflate or deflate prices, leaving unsuspecting investors at a loss. For my proposal for cryptocurrencies, I've decided to say you should invest 40% into Bitcoin. This is one of the most established cryptocurrencies which offers stability and long-term growth potential. Secondly, we've got Ethereum, invest in 25%. This is due to its smart contract capabilities. Ethereum is a cornerstone for decentralized applications, dApps and DeFi, for example. Thirdly, we have Cardano, invest in 10%. A blockchain platform, it empowers sustainability and scalability with growing use cases in decentralized applications. We also have Solana in here. It's popular for its high-speed transactions and low costs. This has become very popular in the last few years. We have Polkadot, 5%. This focuses on blockchain interoperability, enabling communication between different blockchains. And finally, we have 10% going into cash. Cash is helpful as it is completely unaffected by the crypto markets, and your cash cannot be hacked from you.
With the tax implications, from profits from stocks and shares and dividends are subject to tax, and changes may vary in different countries, as not all countries actually take tax off you for any sort of investments. And it may be may not be sustainable for short-term traders such as Forex and any other short-term trading. For example, when Donald Trump came back into power, the USA president, the financial stock markets actually had a surge of returns of 8% within the first day of him coming back into power. The conclusion for the whole portfolio really, I would say cash being held around £10,000 due to emergencies and any funds which is needed and purchases. Global equities are at 50% due to return of investment. You want the biggest return you could possibly have. The bonds at 20% due to but the bonds being quite a safe way to invest, and your passive slow incomes. You might have a big month and have a slow month than before, but you would never really lose your money. Bonds are obviously the best investment, normally gradually spread it out. This would be the main conclusion. What the client I would say we should spend his £100,000 on. Here are the references for what the information we provided today.